Good afternoon, everybody, and welcome to this webinar on impact investing for foundations. My name is Tina Fisker-Henriksen, and I am the Innovative Finance Lead at the Bertha Center for Social Innovation, hosted at the Graduate School of Business at the University of Cape Town. I'm also the co-lead of the National Task Force for Impact Investing. But today I am coming to you as your MC for this exciting webinar, which, as it says right there on the screen, serves as an introduction to impact investing for foundations. In particular, although it can, of course, also be a more general introduction to impact investing. We're hosting this webinar on behalf of the Task Force's Foundation Working Group, which is working to mobilize and incentivize more foundations to participate in impact investing and provide more catalytic capital to help build the market. It's hosted in partnership with Frank Aswani from the African Venture Philanthropy Alliance, with Stuart Theobald from Intellidex, and with Adam Boris from Tshikululu, all very active and participating members of the Foundation Working Group. The format will be such that each speaker will speak for about 20 minutes, and then there will be Q&As immediately afterwards. So please don't be shy. Please bring your questions in immediately afterwards in the Q&A boxes, which the speakers will then respond to. First speaker will be Frank, then Adam, and then last but not least, Stuart will speak. So, I must remember to tell you that, of course, the session is being recorded. And so please don't worry if you are missing anything. You can relive it afterwards. And of course, don't hesitate to reach out to us on berthacenter@gsb.uct.ac.za if you've got comments. Without further ado, I will hand over to Frank Aswani from the African Venture Philanthropy Alliance for the first presentation.
Thank you, Tina. Everyone who's on the call, thank you for making time to join us. Appreciate it, and greetings from very cold Johannesburg. It's like 12 or 13 degrees today. So thank you for making time to join us. Okay, great. So as Tina introduced me, I'm Frank. I'm the CEO of African Venture Philanthropy Alliance. By way of introduction, we are a network of social investors who are seeking to collaborate to increase the flow of capital into social investments across Africa. We're big advocates of making sure that we test and stress test models of capital deployment, challenging our previous assumptions, looking at new ways of making sure that the dollar deployed gets maximum return on impact. We serve a continuum of capital investors because we believe, and you'll see from my presentation, that the solution to solving Africa's social investment financing will be built around greater collaboration. And this is greater collaboration along the continuum of capital, where we talk about the continuum as capital that is seeking impact, but with varying financial return expectations. So from grants that have zero financial return expectations to debt and equity that have market returns of expectations. So we look at that as a continuum of capital and investors. We are part of an international network that includes sister networks in Asia, Europe, and Latin America, which means that we are able to connect African social investors to their peers globally. That is a big facilitator to African social investors being able to connect with their peers for co-investment opportunities, but also for learning opportunities. There's a lot of very mutual problems that the world is trying to solve. And it's not very often that we're deliberate about reaching out to other regions to see what they've done in solving a similar problem, so we don't have to go through the same steps as they did, and we can accelerate our own learning. To set the scene a bit on today's topic, I'm going to talk a lot more about why we need to look at a different model, why the previous model may not work for us going forward. I deliberately didn't put too much COVID context in my presentation because I also didn't want to COVID to overshadow some very fundamental things that we still have to sort out in Africa, which of course have been made worse by COVID. So there are a lot of things that I think we need to think through as we look at what we need to do. So to start off with, we need, according to the SDG Center for Africa, which is based in Kigali, and quite a number of the data I'm using today has come from them. we need about $500 billion to $1.2 trillion annually between now and 2030 to meet our SDG financing gap on the continent. That's a lot of money by any measure, by any standards. And you'll see in a bit why that is a big stretch for the continent. The SDGs are metrics we ill can afford to miss as a continent. So we've got to be figuring out how creative do we get in trying to get that capital into the continent. Globally, I think it's about $5 to $7 million, $1 trillion required. And the reality is that there isn't enough money in the social sector to fund the SDGs. We've got to get a bit creative with regards to how do we source for capital. Now, if you think about it, where else can we find money? The private sector has a lot of money. There's almost $300 trillion in the financial markets. And the question is, how do we get creative with trying to see how we can crowd in that private sector capital, which in many cases views social investments as being risky. They don't seem to understand them, so they're reluctant to put money in them. But there's ways and means which part of this webinar will cover when it comes to figuring out how we can get private sector capital into social investments. Second point there is about population pressure. We are growing, give or take, by about 1 million people a month on the continent. That's huge. And if you think about it, it puts pressure on resources that any country is building. So the more we build, we grow on the continent, the greater pressure it puts on our resources. It stretches us further. And the pros and cons, will go around and pride around the demographic dividend, but that will only be a dividend if we invest in our young people and make them as productive as possible. The growing public debt, and that's been made worse by the COVID-19, leaves the governments with very little fiscal space. They have very little money to spend on development projects, and majority of the money for development projects should come from local governments. And that is being stretched to the limit as we speak. We need human capital to drive the execution of projects. The world is not different. We're all struggling globally. I think you've seen how markets have slowed down. Poverty challenges in Africa are huge. Pre-COVID, we had 400 million people in Africa who were living in poverty. The assumption is that COVID will add another about 100 million people to that number. And it's projected that 9 out of 10 Africans could still be in poverty by 2030 if we don't straighten out a couple of loose ends on our side. Climate change is sparing no one. Governance and accountability is a major issue on the continent in terms of how we execute on our projects and how we use money. With the exception of South Africa, many African countries don't have that strong institutions. And that has limitations on how we can utilize capital that comes in for social good. Corruption remains a problem on the broad scheme of things around the continent. Financial inclusion remains low, but technology like the cell phone has helped hugely in trying to change that. And a lot of this, as I've mentioned, is driven by how much money you collect domestically. So taxation remains a big challenge in the continent. And my next slide here will give you a sense of just the taxation ratios to GDP across 26 African countries to give you a sense of what we look like now. A lot of the developed countries, the taxation to GDP is about 34%. If you look at the range across Africa, South Africa, they're at about 28%. Latin America countries on average at 22.8%. Move further right, the African average of these 26 countries is about 17.2%. And it goes further down to countries like Nigeria, where only 5.7% of the tax to GDP ratio is seen in Nigeria. So that kind of gives you a sense of what it is. And in many cases, especially for the lower income countries in Africa, they need to almost double their tax to GDP ratios if they're to meet their needs. So this remains a big challenge broadly on the continent. If you broadly look at the kind of capital and money that Africa gets, in many ways, broadly looking at these 5 buckets, there's about $500 billion that come in from domestic revenues. Aid is about $50 billion. FDI, about $50 billion. Remittances, it's about $60 billion. Now, that doesn't go directly to where you'd see in terms of social development, but it alleviates the need for a lot of families to lean on governments for social issues around like education, health, and that kind of stuff. So you will see, with that in mind, countries that have more than 10% of their GDP dependent on remittances like Lesotho, Swaziland will be very hard hit by this COVID crisis. And then some of the big countries like Nigeria, which has, I think, remittances of something like $23 billion, Kenya, Zimbabwe, those also will be hit quite hard by the COVID crisis. So we're likely to see this further aggregating the need for us to relook at how we support and create social impact. Illicit flows remain a major challenge on the continent. That there's still a lot of money that leaves Africa in channels that it should, and a lot of unpaid taxes in the process. So those are things that at a policy level, the continent needs to look at how they can fix. In addition to that, another reason that I think you'll find aid is reducing is as more African countries move into middle income, they are seen to be on the path to self-reliance. And as a result of that, they are seen to be less deserving of aid. So it's almost a crisis of success. The more you become successful and grow and develop as a country, you qualify for less aid in many cases. So those are some of the challenges the continent is facing. A bit more detail in terms of the revenue issue. And you'll see, I'll highlight just a couple of things, some of these points. If you look at on the domestic revenue, the second bullet point there, that more than 50% of African countries have less than 60% tax to GDP ratios I've mentioned. And then the second last bullet point is the whole issue around COVID-19 and the impact that we have on Africa. We don't need to spend too much time on that. I think anyone here from any country will see the amount of government stimulus that's been pumped into the economy to try and stabilize the impact of COVID-19. In terms of FDI, there's huge pressure, and I think we'll see this take on even a bit more risk. I was surprised to see that in some markets, people are more willing to put money in negative return bonds and keep money in potential opportunities in Africa that could give the money. So in surplus economies, you find some bonds that have negative returns, and there are people are still putting money in them. So it's a fact of life that we have to deal with. There's investors are managing risk at the moment, so that's something we've got to think about. Talked about remittances; those are going to drop significantly. Countries like South Africa will suffer less because they don't have a huge diaspora population and not that much money comes from outside. But the likes of Lesotho, Swaziland, Kenya, Nigeria are likely to see a bigger impact of that. The aid part, I think we'll spend some time on that as well. This is likely to hit a large number of countries. For the first time, I think, if I'm not wrong, we've seen South Africa go to the IMF for money. That's going to be a huge challenge. And in terms of debt, this is growing. This is going to become another big challenge. We don't know how long the impact of COVID will last. This is going to be something that we'll have to manage and navigate over the next couple of years. I think the impact will probably go to 2022, if I'm not wrong. Opinions out there are still pretty much at best guesstimates that best case things return to normal end of 2021, worst case end of 2022. So we'll have to see how that goes up over time. So that gives you a sense of some of the challenges we're facing. So what all of this comes down to is the money that would have been flowing to Africa and social development and investment space is under huge pressure. And this demands that we think creatively and innovatively about trying to solve this problem as we go forward. Now, when the SDGs were set, there was a certain standard that was set to drive the growth, because economic growth drives businesses, creates jobs, creates tax collection, all those kind of things. And the estimate was roughly the African continent was near to be at about 7% GDP growth. Pre-COVID, we were not exactly there. Post-COVID is going to be even worse. This slide gives you a sense of a couple of countries and where they're sitting. The bars are 2017 and the dots are 2018. If you look at South Africa, for example, which is the biggest economy there, at 1%, and because it's such a big chunk of the Southern African economy, 1% to 2% economic growth, this puts a lot of pressure on the need for us to look at how we meet the SDG targets. So as social investors in South Africa, we need to be thinking, how do we support some of the gaps we're seeing and ensure that the gap between those who have and those who don't have doesn't grow too far, and we bring a lot more social inclusion to our investments. I'm going to pick a couple of just SDG-related metrics to show you. So this is a case of food insecurity. And if you look at food insecurity, when COVID hit us, first of all, it was a health crisis, then it became a food crisis, and now we're almost at an economic crisis. So the food insecurity this slide gives you a sense of what the state of that is. Northern Africa, funny enough, seems to be the one that has the least of a challenge, but Central and East Africa are pretty high. Southern Africa and West Africa kind of mid-level. If you look at enrollment for schools, this is something that Africa has actually made some good progress in. A lot of you I know play in the education space, and you've done a lot of work providing scholarships and stuff like that to take kids to school. But this gives a sense of where we are. The challenge we have right now is to make the curriculum relevant in many cases. If we look at education as a means to an end and not an end in itself, how are we preparing our kids for the future? How are we developing them with the right mindsets, recognizing that they may not have jobs, but they need to create their own jobs. So there's a lot for us to think about if we play in education. The other one looks at access to basic water services. This was quite ironical in many cases when you thought about the COVID crisis, when you told everyone to wash hands, and a lot of people still do not have access to water and clean water for that matter. And so this gives a sense of where we're sitting. Also recognizing that this comes under huge pressure due to climate change. And with that in mind, we need to be thinking creatively about not just conserving water. And this is conserving water from also the huge users of water like agriculture. Like in South Africa, 60% of the water we have in South Africa is used in agriculture. And how do we promote a lot more climate smart agriculture to conserve this very scarce resource? Here's another two things to look at. Access to electricity. And on the left there, you can see kind of world average and 2030 African target. Some countries, Mauritius, are very close and way above the world average. South Africa is pretty close, and you can see the rest going further down. And once again, this has implication on the root causes. So if you look at everything from climate change and you look at our overdependence on hydroelectric power in Africa, what that means. But I almost see all of this as huge opportunities for us to push for renewable energy. We're blessed to be on the continent where solar energy is high, and we really have no reason not to be leveraging some of our other options on the table like solar and wind. On the right, probably one of the areas I worry the most about is this whole issue of unemployment, especially youth unemployment. This looks at overall population figures, and you'll see that it's going to get worse. South Africa alone, the numbers projected is that COVID will add an additional 6 million unemployed people into the economy, 1 million from the formal sector and 5 million from the informal sector. This is going to be a huge crisis. This will lead and will have huge implications, not just in terms of our social welfare burden, and likely we've got a social welfare system in South Africa, but also things like crime, safety for women and girls, safety for kids. There's a lot that needs to be considered coming off this. So what's unique about us as social investors? I think one of the things that social investors are able to do is to be nimble, is to be agile. We can do things that a lot of the big monstrosities called governments can't do. We can be a lot more disciplined in deploying capital. As I mentioned, we need to be thinking of how we crowd in capital from the private sector. We can be agile. We can take a lot more risk to test new models of trying to see how we can finance social investment. We can test new models, trying out things like blended finance, social impact bonds, outcome funds. You'll hear a bit more about those later. We can demonstrate a lot more accountability because this is with the social investors of the nature that are online today. We are a lot more about activity and we're a lot more about impact and outcomes and activity. So I think we can demonstrate models that can be scaled and deliver a lot more impact for people. We also have the flexibility to pool resources. And in a post-COVID space where we've spent a lot of money in the emergency phase of the pandemic, as we look at the recovery phase, we might find ourselves a bit stretched with capital, but this is where we have to think about how we come together and pool resources. There's some really interesting initiatives that have been going on pre-COVID and post-COVID as well, looking at what needs to be done to use the kind of capital, grant capital that a lot of you are sitting on to crowd in private sector capital. And I encourage you to look at those three. There's a Catalytic Capital Consortium that's been put together by MacArthur Foundation, and they've collaborated with Omidyar, Rockefeller Foundation, the OPIC Bank as well. And they've done some really interesting stuff in the emerging markets. The Zero Gap Fund from the Rockefeller Foundation. And very recently, the Ford Foundation issued a $1 billion social bond to try and raise capital for some of the COVID-related needs. As social investors, we need to be asking ourselves, what we invest in? And if you're anyone who's deploying capital seeking social impact or social returns with varying expectations of financial returns, and you look at the bottom there where you may have only social returns only, so you're playing in the philanthropy space, or you're looking for social returns as a priority, so you may be playing the impact investing space, or further right, you're looking at financial returns as a priority, but still with some social impact, you would consider yourself a social investor. And so you're either investing for impact or with impact. But in essence, this is kind of the space that a lot of us are playing in at the moment. And there are a lot of options. The good thing, all this allows us some opportunity for some innovative financing models. Africa's at a very nuanced phase, but frankly, the whole world is still fairly young with impact investing and innovative financing. So we have a really good opportunity to be innovative, to be entrepreneurial, and to try out different things in order to try and address this financing gap. As we go forward, we recognize that the most important thing that we need to do is collaborate. The answer doesn't lie in continued silos of operation. It means that we've got to come together and be able to do that. And that's exactly what AVPA tries to do, is that we try and bring together that whole group of social investors. So your grant makers can collaborate with impact funds, researchers, with corporates, and vice versa. And we can pool our capital, we can pool up our human capacity, we can collaborate with human capital providers, not just financial capital providers. And it's the ecosystem that actually will drive us towards greater social impact. So I'll stop there, and I'll happily take any questions that you may have.
Yes, I was actually just about to drop a message in the Q&A box to say, please drop, or in the chat box to say, please drop your questions in the Q&A box. Just in case, and let's maybe just give that a minute or two. Dr. Michael Hopkins is saying, please can you tell us more about measuring social impact? Do you have any frameworks, etc., that you're working with your members on that you recommend? So that's the one question. And then the second question from Felix Spies is, how does a foundation get involved with AVPA? So maybe we can start with those two.
Yeah, I'm sure there'll be a bit of mention about measuring social impact, but measuring social impact is a critical part of delivering value and demonstrating value. It's an area that I think still needs to evolve a bit better. There are a couple of models out there that are looking at how social impacts can be measured, but frankly, they're still being tried and tested. It's a tough space because of the complexity and nature of what is being done in that space. So there's not one model, I'd argue would be used for measuring social impact. I think there's a couple out there. I'm happy to have an offline conversation with you, Dr. Hopkins, and we leverage, even looking at the leverage we have from our sister networks in Europe and Asia, there's a couple out there that can be used effectively.
Perfect. And then there's a question from Shane Pura asking, if a foundation is not ready to offer investor returns yet through a SIB product, what are the other sources of funding available to them?
SIB is just one of the options. I think there's many other options. There's outcome-based funding. We are talking to a group in Asia at the moment who want to come and do some work in Africa, and they're looking for some outcome-based payer. There's a lot of other things you can look at. Loan guarantees. I did a project in Zimbabwe. I was part of a project in Zimbabwe where this philanthropist did a loan guarantee program with the rural-based women. Over an 18-month period, the bank was able to offer these people concessional loans, and the default rate was very low. It was like 5%, if not less. And these groups borrowed 2-3 times over an 18-month period. So there's various tools available, which will be made available, and foundations should be taken through some of these tools to make them aware of what's available. And then the question about AVPA joining, please connect with me after this. I will be happy to show you how you can join AVPA. My email address will be available, so happy to do that as well. The other question was, what's your experience so far with legal recognition of social enterprise distinct for profit corporations across Africa? We're working on an act in Kenya to include recognition and tax incentives, etc. So this whole incentive and policy space for stimulating social investment still needs a lot of work. I think South Africa is probably the one that's slightly ahead. For example, it's only in South Africa that you get tax rebates for supporting a non-profit initiative. In the rest of Africa, you don't. Yeah, so there's a lot of stuff that's being done. And one of the things that AVPA would like to do is to leverage the lessons coming out of Asia and Europe to see what Africa can learn. So we're going to be doing some work around the policy forum to bring together policy makers from Asia and Europe to engage with our African policy makers to see how we shape the policy space in Africa. So look out for that as something we're going to be doing. The other question that's up here is any possibilities we can have access to presentation and contact. Yes, absolutely. I think this is being recorded, so you'll have access to this. Another question from Melody is, how is AVPA engaging with other members of the ecosystem, e.g. corporates? Oh, Melody, I lost your question. Oh yeah, here it is. How is including corporates, professional services firms, etc., or the IFA market who advise loads of high net worth individuals? So I strongly believe that this ecosystem that Africa needs is not just about social investors. I think we need to bring together people who are deploying human intellectual capital as well. So we are building a network that will involve both financial, human, intellectual capital players. And I think they're an important part of the ecosystem to make everything fit together and flow together. There's a question here from, sorry, I know I have limited time, so I'm going to take maybe another 3 questions. Do you think employee ownership will be funded by impact investment, preserving jobs, creation as a social impact? So if I get you correctly, Tendani, you're talking about employee ownership of companies. I don't have a strong view of that, to be honest with you. I think it really depends on the corporates and how they think they want to create loyalty for them and value for their employees. So, share schemes and those kind of things would be a way of doing that. But one of the things that I probably would have loved to see is, as we retrench people, how do we set them up for future success? But each corporate does things its own way. And frankly, in this COVID crisis, there's a lot of unusual stuff happening that would not have happened on other days. So I don't have a strong view about that. Having worked in corporate myself, it depends also on culturalists. Like American corporates would behave very differently from European corporates. And then what strategies can be adopted to foster collaboration from Tuli? I think, first of all, is to find opportunities to connect people of similar objectives. I think is to find platforms that will give you connection with people who are solving similar problems, not just within your country, but within other countries. I think looking at how you can meet other people, learn from them, check and see how you have mutual areas, what are your shared goals, shared values, that is a good start. So one of the things we're looking to do at AVP is build some platforms to facilitate that kind of stuff, where we gather people around specific problems like gender, youth unemployment, those kind of things. But I think that's one option. I think it's worked very well in our Asian network, just out of interest. And then a last question here from, I hope I'm going to pronounce your name correctly, Dwayne Grisel. We're setting up a collaboration of NGOs in our community with a core focus on children, but doing vastly different things to source and share resources and funding. Will such a body be attracted to the kind of funding that AVP is investing? So just to be clear, we as AVP, we don't fund anything. We bring together investors and funders. So we're an investor-only network, and we bring together investors and funders who then fund NGOs and the likes. And because we want to create a safe space for investors to be able to talk about their investment philosophies and investments broadly, some of the offerings will have like our deal platform. They can then list the NGOs on the deal platform. But some of the work we'll be doing will be very much around that. But I think the broader thing, just to wrap up, is I wanted people to recognize that we are facing a really tough challenge from a financing perspective in Africa around social investments. We need to think differently. And this group in particular, especially because they sit on quite a bit of grant capital and catalytic capital, can play a really key role in using that grant capital a bit differently, not just deploying all of it as grants, but looking at how they can become catalytic investors and co-invest with other private sector investors, because we need those private sector investors to put money from the private financial markets into social investments. Otherwise, we don't have enough money as we speak in social investments to fund our needs. So we need the foundations to think, hopefully adopt a slightly different investment approach. And this is the beginning of that journey of trying to get you to have a different view. And don't get me wrong, we're not saying don't give out grants, but look at diversifying your investment strategy a bit beyond grants. So thank you for your time. I'll hand over to the next speaker. And thank you so much.
Thanks, Frank. I think there was a really good question there in terms of where you think there should be more innovation in terms of creating social impact. And I think you just replied really nicely to that in saying we actually need more innovation in some of the structures, especially in the early stage structures, and more catalytic capital also from foundations. There was one really interesting question that came through that I just wanted to ask you before we say thank you. And that's also how a lot of people on this group can perhaps support the mission of AVPA. What's some of the things that you might be looking for from the ecosystem or from potential partners?
We're looking for investors who are looking to not just maintain the impact, but grow their impact. People who are looking for large-scale impact, people who are looking to learn and grow, people who are looking to collaborate, more so importantly now than ever before. We're looking for investors who have an open mind to trying out new things, trying out new models, because part of what will take them through in the next couple of months is everything from virtual trainings, programs, speaker tours, those kind of things. But the joy is also we'll be able to connect them with their peers in Asia and Europe. I look at something like youth unemployment. There are 3 programs running in India that are teaching kids entrepreneurship in schools, covering 25,000 schools. And in Africa, where when you look at people playing in that space, they're all trying to reinvent the wheel on new programs. And I'm thinking we don't need to do all of that stuff afresh. We can leverage our global network to see how can we learn from India and Asia. These guys are about 5-10 years ahead of us in solving youth unemployment. We need to create 1 million jobs a month between now and 2030 in Africa. You know how many jobs we're doing every year? Instead of 12 million jobs a year, we're doing 3 million jobs a year. We've got a 9 million job deficit. We have no luxury of time to wait for the organic process to follow. We've got to see how we accelerate social impact. So there's a lot of stuff, I think, the value we can bring, but most importantly, is that collaborative platform, that ability to showcase innovation, to showcase new models, and together with some of their partners who are on the webinar today, Tshikululu and Intellidex, we're able to bring that kind of stuff to you guys and with Partner Institute as well.
Great. Thanks, Frank. Thank you very much.
And
I think that's also a wonderful call to action to end on before we also start getting into some of the models and then the more of the nitty gritty. Hey, so over to you, Adam Boris from Tshikululu.
Afternoon, everyone. Thank you so much for joining us. It's great to see such a large number of attendees as well. Really, the purpose of my presentation is like an impact investing 101 for people to really just get their dip their toes into this really exciting sector. And first, just a brief introduction to Tshikululu. So we've been around for 22 years. We're a nonprofit company, and we are social investment managers and advisors. So we work with a broad range of mostly corporate social investors to figure out where they should be deploying their capital and to maximize their social impact, and then helping them to measure that social impact as well. And then I think a really important contextual point as well is how we define social investments. So you would have heard Frank talking about social investors as well. And Tshikululu has a specific definition for when we talk about social investment, what it means. And we think of it as any financial commitment from grant making to impact investing that seeks to drive and measure social impact. So we're really keen on working with anyone who has any capital that wants to drive and measure social impact, and whether or not they want a financial return is less important to us. And basically social investment is driven across what we've segmented into 5 different types of social investors. And there's a lot of detail behind this that Tshikululu has gone through, but basically there's a range of different types of social investors, from grant makers to programmatic grant makers to systemic social investors to impact first impact investors and finance first impact investors. And all of them play a really critical role in driving impact in different ways. And this presentation will of course focus on the 2 on the far right there, the impact investors. So the Global Impact Investment Network is kind of the go-to international body focused on impact investment research and information. And it defines impact investing as investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. Very clear, crisp definition, but there's 4 key characteristics that the GIN has built behind this that I think are even more important and really get to the nub of what this is. So the first is intentionality. So lots of investors, lots of businesses in the world create social and or environmental impact. But a lot of that happens either coincidentally or as a natural byproduct of those activities. In terms of impact investing, there has to be an explicit intention to generate those social or environmental impacts. It's not good enough that it kind of happens by accident. It has to be a key part of the investor or the business's strategy. Secondly is that there has to be financial return expectations. So this is fundamentally different than making a grant as a foundation, where you make a grant conditional or unconditional and you don't expect any of that money to come back. You have to have a financial return. That financial return expectation can range quite broadly. You may even want less than the capital back. You might only want the capital that you gave back. You may only want a minimal return, or you may be seeking kind of maximum commercial returns, but there has to be some sort of financial return expectation. impact investing can be used across a range of asset classes. So there's actually, a lot of people think that impact investing is an asset class on its own, but impact investing can actually be applied whether you're doing equity, whether you're doing bonds, whether you're doing debt. You can apply impact investing to any range of asset classes and any type of investment strategy. And then finally is measurement, which we've already talked about a bit today, is around social impact measurement. And I guess going back to that first characteristic, you have to back up your intentionality with proactive efforts to actually measure what you're generating in terms of social and environmental impact as well. So it's not good enough to be intentional about it, but then not actually make the effort to measure it. You need to really do the work to measure as well. So another way of thinking about social investment, particularly as foundations, is the spectrum that we work with, where you have different types of organizations that get different types of income, they have different ethos, and they attract different types of capital. And so on the far left-hand side, you have nonprofit organizations and public benefit organizations, and they would either be 100% grant income or the vast majority grant income, and then they may do some trading on the side in terms of services or products to generate a bit of income. Those organizations, of course, want to be sustainable. They, of course, want to be successful from a financial point of view, but they are primarily and almost explicitly focused on impact only. So they're just trying to drive social impact. And in most cases, as foundations, we would be giving those organizations grant capital. Then you have this whole ecosystem of social enterprises that could be nonprofit or could be for-profit, some of which are, again, in Tshikululu's definition, a social enterprise has to be generating, or at least have the potential to generate, more than 50% of their income through trading of services or products, but that they might still have some grant income. You might have a nonprofit organization similar to Tshikululu. We don't get any grant income. It's 100% of client fees, and then any surpluses we make, we reinvest back into the business because we are a nonprofit. Or you could have for-profit, socially driven companies that are generating profits, but then distributing those profits to shareholders. All of those companies, in terms of the kind of hierarchy of needs, impact comes first. That's what they're primarily interested in, but finance is very important as well, and they want to be making sure that they're generating those surpluses or those profits. And then again, depending on the type of impact investor you are, the type of organization those are, you may be giving them grants, you may be giving them impact investments. And then you have profit-driven businesses that are intentional about their social impact and they measure their social impact, but they're primarily focused, again, in that hierarchy of needs of driving social impact. And then on the far right-hand side, it's more just to make the really key point that traditionally the way business has engaged in social impact is they make their money over here, and then they take a portion of those profits and they do social good over there. And impact investing, the real power of this whole space is trying to bring together these worlds that generally don't mix into a much more integrated and hopefully powerful fashion. And then just to make the point that most foundations in South Africa, in Africa, and around the world are still really just playing in that left-hand side of the spectrum, whereas this impact investing space is, although it's more than 10 years old now in terms of the kind of formal terminology, it's still very new, and a lot of new players and people getting into the space. And so by no means are you late if you're only starting this now. Everyone's still trying to figure it out. This is, again, particularly for foundations, a really helpful matrix that we use, where on the y-axis you have the willingness of a customer or a beneficiary to pay for something, whether that's a service or a product. And then on the x-axis, the ability of that customer or beneficiary to pay for something. So if you're a foundation, a social investor, and you're thinking, I have some capital that I want to deploy towards social good, and how should I do that? This is one way of thinking about it. So in the upper left-hand quadrant, you have a customer or beneficiary who's willing to pay for something. They think this would be a valuable product, a valuable service, but they just aren't able to pay for it because of unemployment, poverty, low income, competing priorities, whatever it might be. And so in a situation like that, probably a grant is the right solution for that situation, because you're basically subsidizing someone's ability to pay for a service that they would like to be able to pay for, but they can't. In the upper right-hand segment, you would have a place where there's a customer or beneficiary who's able to pay for something, and they're willing and interested to pay for that service. And in that case, very clearly that's an investment opportunity, because there's actually a market there that can actually solve that challenge or fill that gap through a market-based solution. one of the challenges as foundations is very often we actually deploy grants in a situation like that, where either you're distorting the market because there's actually people who can pay for it, or you're just taking very limited capital that you have as a foundation and deploying it somewhere where it could actually go to better benefit elsewhere. Then in the lower right-hand quadrant is an interesting kind of space for innovation. There are a few questions around innovation. And this is one of those places where you have a customer or beneficiary who's able to pay for something, but they're not willing to pay for it. And so I often think about a famous Steve Jobs quote where he said something along the lines of, customers don't know what you want until you give it to them. And so this is that space where foundations can play that real catalytic role and pilot innovative solutions that people may not actually realize this is a huge service that could really improve your life. And then once they actually figure out that this is something that is worthwhile, they have the ability to pay for it, and it could be moved into that kind of market-based space. And then finally, in the lower left-hand quadrant is a space where you have no willingness and no ability to pay for something. And so basically you should avoid that situation altogether. Again, in our space as foundations, we often find that people are kind of trying to force feed a solution into a situation like this where people actually aren't interested, they're not able, and so rather deploy your capital somewhere that's going to be more useful. So just in terms of a global snapshot at a very high level in terms of impact investing, the GIN puts out an annual survey. So this is the most recent data that came out of the GIN, about $500 billion of assets under management in impact investing. It's grown 17% year on year over the last 4 years. So growing a lot, a pretty big number, but as you would have heard Frank say, $300 trillion of investment capital in the world. So this is much less than 1% that's in impact investing. So there's still a long way to go. A few really exciting things about the space though. So one is here under impact target setting. Traditionally, a lot of investment houses would have all of their assets under management and they'd say, okay, we're going to take 5-10% of this investment and we're going to ring fence it and we're going to invest for impact. But it's kind of something on the side. It's a small amount of their capital. What we're seeing is a growing number of impact investors that all of their capital has impact targets next to it. So it doesn't matter what they're doing, they're always trying to drive impact through everything that they do. And I think there was a key question around Tendani around the kind of jobs and unemployment and securing job creation in terms of impact. And I think it's a real important question for South Africa and Africa as a whole is each country needs to define what does impact in your context mean for you. In South Africa, where unemployment is such a massive problem, particularly the youth unemployment, is it good enough that you're just creating jobs for young people? And no matter what your business model is, even if you're selling cigarettes and alcohol on the street, if you're creating jobs, does that mean that you're generating impact? And that's a question that every impact investor needs to grapple with to define what does impact mean to you. Really interesting for this call, only 14% of this $500 billion is allocated to sub-Saharan Africa, which is really counterintuitive and always surprising every time I see it, where you have a continent with huge opportunity and also huge challenges, but that actually the majority of impact investing capital at the moment is going to North America and to Europe. And then finally, almost any sector you can think about, there is impact investing happening, but from a kind of the most popular sectors, renewable energy, which Frank mentioned, financial inclusion through microfinance and other services, food and agriculture, and then water and sanitation and hygiene. In this first introductory section, I just wanted to make a key point around terminology, because I think it's a really big challenge as foundations and people who typically have worked in the kind of nonprofit space where terminology is a huge barrier to being comfortable playing in this space, to being open to playing in this space, because you just get kind of turned off by this whole different world. And so I just wanted to go through a few things. So the first, in the nonprofit world, you have beneficiaries, you make grants, you're generally a donor, and then organizations are generating surpluses at the end of the year. In the impact investing world, we talk about customers or clients, investments, an investor making those investments, and then these companies are generating profits at the end of the year. So again, slight differences, but it's just a different way of speaking. But then these next four, I think, are even more kind of stark. So in the nonprofit world, as foundations, most of you have probably supported some sort of capacity building activity during your work. And that would be, supporting organizational development for nonprofit organizations to become more effective at what they do. In the impact investing world, the exact same thing exists for for-profit companies, and it's mostly called technical assistance, but it's the exact same thing, providing organizational development to businesses to help them be more effective at what they work. In the nonprofit world, you have what are called donor exits, and in most cases, a donor exit is a negative thing. So if I'm a nonprofit organization and one of my donors is exiting, that's either because they've had a strategy change, or we haven't performed up to scratch, or the donor doesn't have any money anymore and they're exiting. We're now losing a funding stream, and that's a problem for us. In the impact investing world, you have what's called investor exits, which are sometimes negative, but very often are actually a positive thing in the impact investing world. And this would be where you have an investor who's taken equity in a company. So let's say a company is worth $100 and I want to buy 10% of that company, so I pay $10. And then 5 years down the line, that company has done really well. It's now valued at $1,000. So my 10% is now worth $100. And I decide I actually want that $100 so I can go invest it elsewhere or use it in some other way. So then I exit that investment by either selling my shares to another investor or selling it back to the company so that they now have more equity to control. And so usually it's actually a good thing. Now the investor has made their money. The company either has a new investor that's going to help it grow to its next stage, or it actually has bought back some of its equity and it has more control of its own company. In the nonprofit world, you have what's called the theory of change. It's kind of causal link. If we do this, it will lead to this, and that will ultimately lead to whatever social impact we're trying to accomplish. In the impact investing world, you have businesses that are what's called an impact thesis. So as part of their business model, they build an impact thesis for the exact same thing. What are we doing? What is it going to lead to? And what's the ultimate impact? Again, this different terminology that just creates unnecessary division and kind of conflict, for lack of a better word, between these two spaces. And then lastly, in the nonprofit world, you have monitoring and evaluation. In the impact investing world, it's normally called impact measurement and management. But once again, the exact same thing. Figuring out, choosing your indicators, how often are you going to collect that data? How are you going to verify that data? How are you going to use that data to determine whether you're being successful or not, and then change strategy as necessary? So there was a question in the comments around, give an example of an indicator you might use in an impact investment. I think it's a really important example of this, where an indicator that you would use in the nonprofit space can very easily be used in the impact investing space. There's no fundamental difference between the type of indicators that you're trying to measure. So if I'm an impact investor and I'm investing in an agriculture business, I would probably want to measure from a social impact point of view the yield on the crops that the farmers are growing, or the amount of income that the increase in income that they're getting from selling those crops. And similarly, if I'm a donor funding a nonprofit agricultural program, I'd probably try to measure very similar things. So there isn't a kind of fundamental disconnect between the types of indicators you might measure in these two different worlds. So there's two very high-level misconceptions that I think are really important to talk about. The first is that impact investing requires the sacrifice of financial returns. So there's a strong narrative in the world where if you want to drive social impact, there's no way that you can make maximum returns. You have to make less money if you want to generate social impact. There's a growing body of rigorous research and evidence around the world that that's just not true. Comparisons of impact portfolios versus traditional investment portfolios, where the impact portfolios perform just as well, or in some cases even better than the traditional portfolios. But I think what's really important here as foundations is that foundations very often deliberately sacrifice their financial returns. So they don't have to. It's not something that is, because I'm trying to have impact, I need to reduce my financial returns. But foundations have this really unique space in our ecosystem where, because foundations are trying to drive social impact, they can invest into opportunities in a way that either tries to just maximize that social impact while getting some financial return, but can also de-risk other investors. And this is getting into more technical language, but basically making investments that make a deal more attractive to a traditional investor that would never have invested in that deal if it wasn't for the foundation investing it first. And so it's really important as foundations that there's a deliberate sacrifice at times, but it's not a necessity. And then another important misconception is that impact investing is superior to grant making. And Tshikululu feels that this is really built into kind of deep societal narratives around the finance world being more sophisticated or more important or more wealth creating. and the nonprofit world being less sophisticated and, oh yeah, that's nice, people are trying to help people. So there's this narrative that impact investing must be the silver bullet, it must be more effective because it's kind of financially based and sustainable in that sense. Where our view is that the vast majority of social challenges actually don't lend themselves to market-related solutions. And in most cases, you actually need grant capital in order to address social challenges. And again, as foundations, I think it's really, really important. And what makes a good foundation, and in Tshikululu's view, what makes a good social investor is looking at whatever social challenge you're trying to address and saying, what's the best way to try to address this challenge? And don't come into that discussion with kind of blinders on where you say, we only do grants or we only make investments, but actually coming into that discussion with an open, flexible, as Frank said, an agile mind of saying, maybe in this situation we should give a grant, but actually in this situation it makes more sense to make an investment, and so that you can kind of deploy the right capital to the right challenge. There's lots of different ways you can do impact investing, and these are just three at a very high level to explain different ways of doing it. So one is direct investment or investing into a fund. And this is very much like a traditional investment. So a traditional investor puts together a portfolio where they decide, what sector am I going to invest in? What business stage am I going to invest in? What's my risk appetite? And what type of finance am I going to provide? An impact investor will do the exact same thing, and then they'll add a social impact component to that as well. So what kind of social impact am I trying to achieve? And how am I going to measure that social impact? And then when I'm doing due diligence as a social investor, as an impact investor, I'm going to make sure part of my due diligence is a rigorous social impact due diligence. Can this company deliver on its social impact promise? What's its impact thesis, and is it legitimate? And is there a track record of them actually generating social impact? And then when I'm doing my management and my monitoring of that investment, am I getting social impact returns? Are they the returns I expected? And if not, why not? And what do I need to do to change? And then again, as foundations, you'll often hear this term patient capital. It was coined by an organization called the Acumen Fund several years ago. And patient capital is this idea of impact investors that are willing to be more patient than a traditional investor in order to drive social return. So you might have longer time horizons. A traditional investor may say, I'm going to give you a loan, but I want to be paid back within 3 years, while a patient investor might say, you have 5-7 years to do it. I might have more of a risk tolerance, and I'm generally going to be trying to maximize social returns, and therefore a little bit less focused on the financial returns. So these are just 4 companies in Africa that are impact businesses that have attracted quite a large amount of impact capital. Mkopa in East Africa is a renewable energy company, basically connecting homes to off-the-grid energy. Spark Schools in South Africa, low-cost private schools that more than 20 in the country now that are providing kind of quality education at a very low price point. Zona is a financial inclusion company in Southern Africa, basically trying to provide financial services to the unbanked. And then Twiga in Kenya is agriculture aggregation company. And so these are just 4 of literally thousands of examples, but just to give you an idea that there are lots of companies attracting lots of capital and providing really necessary social impact services all over the continent. A second type of impact investment is what's called outcomes-based financing. Lots of different ways this can work, but social impact bonds is one type of outcomes-based financing, something that probably many of you would have heard of. Very often people think impact investing equals social impact bonds, which is not the case. That's just one type of many different types of impact investments. But at a very high level, how this works is you have an investor at the top who wants to generate some sort of social impact. So let's say in this case, they want to increase graduation rates in high school. So they make an investment through an intermediary who kind of coordinates this whole structure into a program implementer, which is usually a nonprofit organization, but doesn't have to be. And they implement some sort of social impact intervention to increase graduation rates based on pre-approved targets with the investor that, let's say, they're going to increase by 20% over the next 3 years. At agreed intervals, an independent evaluator comes into this situation and they go to the program implementer and they verify whether or not those targets have been reached. If the targets have been reached, the evaluator goes to this donor or an outcomes payer, which is often a foundation, and says, the targets have been reached, please pay the investor back their money, either their capital, sometimes it's their capital plus a return. If the evaluator goes and they found actually these targets haven't been reached, they go to the donor and they say, you're off the hook, the targets weren't reached, therefore you don't need to pay anything back. So why this is a potentially really powerful structure, there's three different reasons in our view. So one, monitoring and evaluation is built into this structure. One of the biggest criticisms of foundations, nonprofit world, social impact world is that measurement is a real challenge. There's very poor measurement. So this one has hardwired measurement in as part of the structure. Secondly, it kind of turns on its head our normal thinking of how you drive social impact. So usually you have a donor, makes a grant to a program implementer. If that program implementer succeeds, that's great. This is a great grant that the donor just gave. But if that implementer fails, then the donor has basically lost that funding. There's nothing you can do about it, and you move on. In this case, the investor takes on all of that risk. So the donor only pays if success has been had. So you're basically only paying for success, which is obviously a much more efficient approach if I'm a donor. But then the most important potential here is that in an ideal world, this donor or this outcomes payer is government. And why that's so important is, let's say it costs government it costs government $15 to generate a high school graduate. And this investor comes in and says, I think I can do that for $5. So they make an investment, and at $5 to create high school graduates, the program implementer does whatever intervention they do, and they're successful. So what that means is now the government can pay this investor back $10, and now the investor has made $5, the government has saved $5, and we have an increase in the number of high school graduates. And so there's potential for really great efficiencies in terms of public sector spending if you can get these structures to work at scale. One of the challenges is there's very few examples of these happening at scale so far, but that's the kind of promise of them. So in South Africa, this is a slight variation on that social impact structure, but this is the Green Outcomes Fund, which is a relatively new structure that's just rolling out in South Africa. And basically you have a fund here which has some funding, and they enter into contracts with a number of recipient funds who are then investing in green, small and growing businesses. So these are small businesses that are trying to drive green outcomes, saving of water, improved climate, those kind of things. And basically, at a high level, what this says is these recipient funds would generally not invest in these companies because it's too risky. These are two new business models, a lot of innovation and risk happening in this space. And so the Green Outcomes Fund says, if you invest in those companies and those companies verify specific targeted green outcomes, then the Outcomes Fund is going to pay the recipient funds back money. So they're basically incentivizing those companies to invest in green companies that can drive green outcomes. An interesting structure, but what's more important is this is a great example of how foundation capital can leverage much larger pots of capital. So one of our clients, the First Rand Foundation and the RMB Fund, made roughly 8 million rands worth of grants to the Green Outcomes Fund to set it up. That 8 million rands allowed the fund to unlock a further 80 million rand from the South African Jobs Fund. And then that 80 million rand is going to be used to leverage the 450 million rand that those recipient funds are going to actually invest into those small businesses. So basically a foundation makes a grant of about 8 million rand and unlocks 540 million rand in social impact capital. So it's a really great example of how you can leverage foundation funding for social good. Then the last example of a different type of impact investing is guarantees. And so a guarantee is basically exactly as it sounds. If I am an impact investor and I see a business model that I think has great promise, but that business thinks it's too risky to take out a loan because they're not sure they're going to be able to pay it back, or a bank thinks it's too risky to make a loan to that business, the impact investor comes in and says to the bank, I will guarantee that if this company is not able to pay back the loan, I will cover the loan for them. So you're making a loan guarantee. Why this is really powerful, an example, again, in South Africa, is one of our clients, the Discovery Foundation, set up a medical student loan guarantee fund. So this wasn't for businesses, this was for individuals. Basically went to one of the big banks in South Africa and said, please make loans to this group of students that are studying to become doctors who you wouldn't have made loans to otherwise because the risk was too high. we're going to put down a 20 million Rand guarantee. Based on that guarantee, the bank was able to unlock 200 million Rand worth of financing to those students. And then once those students graduate and they get a job, they would start to pay back those loans. But if they default on that loan and they're not able to pay for some reason, Discovery has said, we will cover those loans for you. Why this is really powerful is assuming that no students ever default on those loans, or it's a small percentage of those students default on those loans, that 20 million Rand that's been kind of ring-fenced for this guarantee can be used to unlock this first 200 and then another 200 and another 200. So you could theoretically unlock billions of Rand of capital by just putting down a 20 million Rand guarantee as a foundation. And so it's another really exciting example of being able to leverage small amounts of foundation capital to unlock a huge amount of private capital towards social impact. And generally where you see these guarantee funds all over the world, as long as they're designed effectively, very, very low default rates, 99% repayment rates, 98% repayment rates is very typical what you would see. And finally, in closing, just want to take a few points around kind of what it takes for impact investing to thrive. As I said, it's still a very nascent space. It's still very new for a lot of people all over the world. And in each of your geographies where you're working, I think a few things to keep in mind. So one is regulation. If you don't have the right regulatory environment, particularly as foundations, it can be very difficult to deploy impact investing capital in innovative ways. This is a real challenge in South Africa, and something we're engaging with regulators on is how do you make it more conducive? So you really need to get the regulation right. Although impact investing is 10, 15 years old, it's still very much a space for pioneers. You need people who are willing to take risks, willing to do things that haven't been done before, and willing to kind of take off those blinders, as I said, and start to kind of stretch the different ways you might be able to deploy capital. And this is really about finding a balance. So as I said, this is about this for-profit world and the non-profit world that have very often either been completely separate or at worst case actually see each other with distrust or disdain. And this is really about trying to find the balance and finding the good things from both the for-profit investing world and the non-profit grant-making world and bringing those together in order to drive social impact in new ways, and how you find that balance. And then most importantly, forming unlikely alliances between impact investors, grant makers, nonprofits, social enterprises, collaborative platforms like AVPA, and really trying to find those unlikely alliances to be able to drive impact in new ways and help to drive social change. And that's it. And these are just a few resources when we share the slides that we found to be really useful in terms of entry-level impact investing information that I would recommend that people go through. Okay, let me see here on the questions front. Okay, so I have a first question here from Tabang. Is social discounting rate relevant in impact financing models? Is the first question. So if I'm following you correctly, basically I think what you're asking is, would you discount your financial returns in order to get social impact? And I think the key point here is that you can do that, but you don't have to do that. So you can decide, I'm going to reduce my financial return expectations because I want to maximize my social impact. And you can very, very easily do that. And there's lots of really innovative ways of doing that as well. So for example, if I'm an impact investor and I make a loan to a company and I say, I'm going to make you this loan and your repayment rate is 10%. But if you hit certain impact targets, I'm going to reduce your repayment rate to 5%. So you can incentivize social impact in lots of really innovative ways. The second question here is, in cases where impact financing helps to de-risk the investment, is it not equivalent to throwing the good money after bad? It's a very good question, and I think there's a lot of debate in this space. And it really comes down to what type of investor you want to be. So again, if I'm a foundation and if my priority is to try to crowd in as much private capital as possible to try to drive social impact, as Frank said, we have this massive financing gap in Africa. If I'm a foundation and my main priority is to just crowd in capital and maximize the amount of capital going towards social good, then by de-risking the investment and taking a lesser return for myself as a foundation, while not being irresponsible, but taking that lesser return, then I'm actually achieving broader impact targets in the long run than I would be by saying, I'm not going to reduce my risk because I think that's unfair and I'm just helping someone else to get rich. It's really around what priorities do you have as an impact investor, and how best can you play in this very broad ecosystem? Another question from Shane is, how can a foundation work with the relevant entities like yourself to leverage funding towards tertiary education as the example of discovery on other degrees, engineering, accounting, actuarial, and other critical skills? I think that example of the Discovery Fund, the Discovery Foundation guarantee, is just one example, and they happen to focus very specifically on medical students, but you could do it, as you say, with almost any degree, particularly in the critical skills area. We've engaged with another client around, so South Africa puts out a list of kind of occupations of high demand every few years and targeting just those occupations. And so it's very doable across any sector, as long as it's really about, can you set up a guarantee that minimizes risk for both the individuals or the businesses and the finance institution that's providing those loans, and that it works for everyone based on the kind of, as you say, actuarial issues. So happy to discuss that offline if that's of interest. Noktula says, how does one enter the impact investing world? I think the first thing is to just not be intimidated by it. I have a nonprofit background. For the first 10 years of my career, did nothing but nonprofit grant making. And then I just started reading and engaging and researching on impact investing, because for myself personally, I felt that grant making is incredibly powerful. It is, as I said in the beginning, there's this whole spectrum of social investors, but grant making alone isn't going to solve the challenges that we're trying to solve. And so the broader church that we can bring into this space, the better. And so I just started reading, engaging, talking, studying, and you just kind of find your way. But I think that the key thing is just don't be intimidated and don't feel like it's something that's beyond me because, and I don't know, Noktula, if you're from a nonprofit background, but don't feel like that's too much because I have a nonprofit background. It's never that simple. What is the market appetite out there for social impact investors? I think it really depends, I guess, is the short answer. You have some sectors and some countries and some areas where there's huge appetite, both from investors, and there's a huge pipeline of businesses where you can invest. And then there's other places where it's still very early days, and there's a very limited number of companies that are actually investable. And there is a very limited number of impact investors who are actually trying to play in that space. So it's very much a kind of a depends answer. Can you give some example of SIBs used in South Africa? What are the challenges being experienced in setting them up? So in South Africa, there are currently 3 different outcomes-based financing structures that we know of that have been successfully launched. So the Green Outcomes Fund, which I mentioned, a second one, which is on early childhood development in the Western Cape, and a third one, which is looking at youth employment. And happy to take it offline, but there's lots of lessons learned in terms of, one of the challenges with social impact bonds generally is they're really complicated. And there's lots of players that are involved there. And so trying to coordinate this structure, there's often lots of legal fees because there's lots of contracts that need to be signed. And so trying to make them as efficient as possible is a real challenge. But happy to discuss that more offline. And then, is there space for corporates with their CSI, SED budgets to move into being an impact investor while not losing sight of what the different elements of BEE requires of corporates? For all of our listeners who are not in South Africa, BEE is the broad-based Black economic empowerment regime of the country, which is basically trying to overcome the injustices of the past and the inequities of the past. And so each foundation and each corporate has requirements of spending in order to contribute to Black economic empowerment. I think, Tabile, to the regulation question, this is a key one. And one of the things that we're trying to engage with SARS and with others on is how to open up the space to allow foundations, particularly corporate foundations, to invest in this space without risking their BE status in any way. There are ways of doing it now, but it's not that straightforward and not that easy. And so it's a matter of how you structure it at the moment, but we need to make it more flexible. There's just a few more. I think I have about 2 more minutes. Ivana says, what type of impact investing would one seek to support education and youth employment initiatives that target underprivileged youth specifically? For example, creating pathways for youth into tech jobs. So I think it's a great example of where impact investing is just as diverse and just as broad as grant making. So if you ask that same question, you say, what type of grant making would one seek to support? to drive education and youth employment. There's a huge range of grant-making strategies and other activities that you might support. And similarly, in impact investing, it's really about identifying the specific challenge you're trying to address. So in this case, youth employment and youth education, and then looking at the specific context you're trying to address that challenge. And so, for example, if you're looking in a community that has very limited discretionary income that they could put towards an education initiative, then they might be less likely to be able to do impact investing in such a space, and maybe they would be more likely to do something in a grant space. Whereas if you're looking in a community that actually does have a bit of willingness and ability to pay for something, you would be looking for businesses that can help fill that market gap, and then you would invest in those companies. So there's no kind of straightforward answer. It's really about applying different thinking to social challenges. And then Bortumelo says, what are the impact investing research gaps or areas you think should be explored? I can maybe hand that over to Tina because she works for a university and they do lots of research, but there's still huge gaps in research that needs to be done. And I'll just do the last question because it says, what does the name Tshikululu represent? That's from Arif. Tshikululu is the name of a tree that's found in the north of South Africa, which is called the African rock fig tree in English. And it basically is a tree that can grow in very adverse circumstances. So it can grow out of rock. It can grow in really difficult circumstances. And so Tshikululu is a metaphor for being able to kind of grow and thrive in very difficult circumstances. But I think I've run out of time, so I think I'm going to stop now.
Thank you, Adam. And I'm a bit disappointed you threw that back to me. I was going to ask that as the bridge question because I'm quite keen to also hear your answer to that. One thing is, of course, as Frank and as Adam has talked about, there's a massive opportunity for foundations to really play a role in providing catalytic capital. But there's also a lot of foundations that we've seen that really play a very significant role in also pushing research and more market building organizations, etc. For instance, the National Task Force for Impact Investing in South Africa is supported by the Ford Foundation. But I will give you my response, Adam. I think obviously there's massive research gaps across the risk return spectrum that both Adam and Frank has shown and visualized. And obviously lots of different examples in terms of which blended finance, which new innovative finance products, which early stage finance products, all of that can be used and explored. But I think in South Africa and a lot on the continent as well, one of the big bottlenecks that we face is really the gap around hardcore data around the performance also of social investments. We haven't necessarily, or we have to some extent, but there's more work to be done in actually building the business case for more early stage impact investments. And what we need to figure out is a little bit around the data and also the impact of the financing in terms of leverage ratios, etc. So that's one of the things that definitely could be explored further. Thank you so much, Adam. That was very valuable. And I see a lot of comments in the question box, so that was really great. Stuart Theobald from Intellidex, over to you to hear a little bit more about foundation strategies.
Thanks very much, Tina, and thanks, Adam and Frank, for their addresses. Good afternoon, everyone. Nice to be with you. I will hopefully touch on a few things that the other speakers have said, but in the context of looking at things from an endowment perspective. So as a foundation in managing an endowment, that's a portfolio of assets, how does one think about impact investing from the context of that endowment? I'm going to go through a presentation, should be coming up on your screen now, just a bit on what's coming. I want to first talk a little bit about the traditional model of how we think about asset management in foundation assets versus the grant-making function. Then talk a little bit about the asset management side, particularly the investment policy statement and how that works in guiding what one does with one's assets. Touch on a theme we've talked about this afternoon at length, which is how we see financial returns versus social returns, leading on to a capital continuum from traditional investing through to philanthropy. I'll say a bit about blended finance and where that fits in. And finally, just some practical steps to take as a foundation to start thinking about what one can actually do to implement impact investing. A little bit on Intellidex. So, you know, we're a research and consulting company. We really do four things. One is capital markets research. So we deal a lot with big institutions from around the world who are buying government bonds or portfolios of shares and so on. And we produce research for them. We do a lot of market research, primary on-the-ground research, largely for financial services type of clients. We do strategy research for banks, investors, and political economy research on understanding the evolution of politics and policy with it. And oddly, we found ourselves with this kind of range of skills quite involved in the impact investing question, both from our capital markets kind of research hats and in strategy research in thinking through how non-profit organizations should shape strategy in response to impact investing. So we do a lot of skills development, review of strategy, and we then produce research to guide investment decisions around impact investing. So I want to start just by painting a picture of how we normally think of a foundation and its asset base. So on one side, you've got an endowment. This is a pot of money that may have been endowed in the founding of the foundation or is actively contributed to over time from the profits of a sponsored company. And that endowment is managed to derive a return. And that return aims to do two things. One is protect the capital value of the endowment so that it stays evergreen and is there for the long term. And then to produce returns in excess of that, which go into funding projects and into the grant-making activities of the foundation. So this is a typical picture. And the way most foundations do things is you outsource the asset management of the endowment. That goes to a traditional big asset manager, the likes of Allan Gray or Coronation or Sanlam and Old Mutual and so on, all play in the space of managing the assets of foundations. And then the foundation itself focuses on running projects and grant making, and that it sees as its core competency. And really there's a dotted line between these. There's maybe a report that gets produced periodically about the performance of the endowment and forecasts on cash flows and so on, that goes over to the foundation, but the two functionally operate in quite separate worlds. Now, the asset manager has a job, though, that is defined for them by the foundation. The foundation is their client, and that job is put into what is called an investment policy statement, and in asset management, that's a very crucial document. It sets out what your job is and defines the guidelines for what you do. So it specifies the governance arrangements, delegation of responsibility between the asset manager and the foundation and its board or an investment committee. It sets investment objectives, such as protecting the value of the endowment as well as funding the foundation. It sets return objectives. So typically in a South African environment, you might have a return in objectives such as inflation plus 6%. It sets risk requirements, which should constrain asset class exposures. Do you want to have very risky assets in there or not? It sets the risk tolerance, so understanding just how able to carry risk a foundation is. If the endowment is small and expected to grow over time, you don't want to be investing in high risk and highly volatile assets. It sets liquidity requirements. You might need cash flows to support grant making over time, especially when you have multi-year projects. It sets investment strategy philosophies, so that investment policy statement can say to your asset manager, we want you to apply ESG criteria, for example, in how you select investments in our portfolio. It might have some screening rules to prevent investments in certain kinds of companies and so on. And then it sets reporting guidelines, how that asset manager should report over time. Now, let's just think about what the asset manager does in that orange block compares to what the foundation does in that blue block. Adam mentioned the idea of finance first versus social first investors. So these are investors who are either prioritizing the financial return or prioritizing the social return. So we can think of these as two axes. You can have financial returns I put here on my vertical axis and social returns on my horizontal axis. And these can be positive or negative, right? Your asset manager is given a job. They have a return target of, say, CPI plus 6%, and that puts them there. But your foundation is also sitting on a finance and social return continuum. And their objective is to maximize social returns according to their mandates that can be captured in trust deeds or other documents that set out the purpose of the foundation. And they aim to deliver on those social objectives. And generally, they do it by obtaining grants, obtaining funding out of their endowment and using that to fund grants. So we can think of them as a minus 100% finance return because it's providing grants and not expecting anything back financially, but a maximal social return that its objective is. Now, those are two positionings of what your asset manager is doing and what your foundation is doing that sit on the social versus financial return continuum. And as I'm going to start to now tell you a story about how these two things can start to blend towards each other. So we talked a bit about continuum, both by Adam and Frank, and here's how we tend to think about this. On the left side, you've got standard traditional investing. So this is the asset manager or hedge fund or whatever, whose aim is really to maximize returns while managing risk. And that's a traditional approach, and they're unconstrained. They can invest in anything in the world in order to do that. At the other end, you have traditional philanthropy, and that's philanthropy to support charitable causes through making grants. There, the objective is social impact, not financial impact. But what's happening as the debate over impactful investing is growing is that there is a movement of traditional investing towards greater consideration of the social consequences of investing. And then there's a movement also in the other direction from the philanthropy side to start to think about how we can use financial instruments and financial tools and financial markets to leverage up the social impact that can be had. So any foundation or any charity has a finite amount of money at their disposal, and perhaps they can leverage that up by accessing financial markets to have greater social impact. So these two are, if you like, starting to move towards each other. Along this continuum, you've got different kinds of strategies. So traditional investing has, for several decades now, for instance, used tools like investment screening. So one might say to a fund manager, you can invest in anything, but you can't invest in tobacco or alcohol or arms companies and so on. And that negative screen knocks out certain companies. And that's a sort of probably the oldest mechanism through which traditional investing has been shifted to have better social consequence. But then you have, I think, probably a more developed step is to go into ESG strategy. So ESG is environmental, social, and governance, where you look at the consequences of the investment you're making in a more positive way and trying to understand and measure it from its consequence in terms of environmental, social, and governance impact, and sort of tilting your portfolio towards investments that have higher ESG metrics and higher performance. And you have along that the idea of sustainable investing. Then you get thematic impact investing. So some investors set specific goals. It might be, say, the Sustainable Development Goals. It might be a subset of those, maximizing employment or healthcare or livelihoods. And those particular themes can become the guidance of what kind of impact a fund wants to have. And then you have impact first investing, which really does prioritize impact over financial returns. And finally, you have philanthropy, which still does the grant-making role. And I fully endorse Adam's point that grant-making is never going to go away. Grant-making remains an essential part of this continuum. And it as I'll say a bit more, is essential because it unlocks lots of other forms of funding that might be available. So this kind of growing realization that the asset management function and the grant-making foundation function are slowly coming together, and that the world of the asset manager and the world of the foundation are blending towards each other. So here's just an example of how different activities can fit along this continuum. So we as Intellidex have been quite involved in the COVID crisis response. And if you look at how the financial markets and funding has responded to the COVID crisis, you really see along this bottom here the range of different entities that have fitted in. So in the philanthropy end, you've had the Solidarity Fund that's raised, last time I looked, over 3 billion Rand. to support through grants and through donations into the fight against the pandemic. At the other end, in traditional investing, you have the standard set of government bonds, and government raises finance. If you followed Tito Mbowene's budget speech last week, you would have heard we need to raise an additional 300 billion rands worth of finance to deal with the epidemic and its economic consequences. And that's a standard financial market tool to use. But in the middle of those two ends, on the impact first side, Johan Rupert put R1 billion into business partners to be used in a blended finance approach of both grants and loans to support small businesses and to keep them open and keep their employees in their jobs. The Oppenheimers did a similar thing through an entity called the SA Future Trust that they set up, which operated through the banking system in providing grants and loans. So they used a loan tool, but from 1 billion, they managed to leverage that up by accessing balance sheets of banks and business partners respectively to have greater impact. In between these, there are COVID-19 social bonds. Now, Intellidex developed a proposal for the South African sovereign to issue a 100 billion rand social bond. There have been several countries now that have done so. The first was Guatemala, that issued one a few weeks ago now. We've seen a variety of one from Ivory Coast and other countries who are now entering the space, where these are bonds issued to investors who are aiming to achieve a social return and not just a financial return. So this, I think, really conveys the point I want to make clearly, that the aim here, or an opportunity exists, to consolidate the asset management function and the foundation functions to maximize impact. What do I mean by that? So in my earlier graph, you had the asset manager sitting up there aiming to deliver a positive financial return, but not much focus on social return. And you had the foundation aiming to focus on social returns without thinking about financial returns. But these two are pulling together, and you end up with a strategy that can be unified and to maximize the social outcome of the whole portfolio. So the objective here is higher social returns than operating separately, but still maintaining the financial returns. So Adam made the point that impact investing is not necessarily at the cost of financial returns. I think that can be right. I think conceptually, when it comes to the asset manager choosing to invest in instruments that are impact instruments, the appetite in the asset manager needs to recognize that they're going to be paying for social returns. So they're going to be giving up some financial return in order to earn a social return. That's, I think, the right attitude from the asset manager. But the attitude from the foundation should be that one has a set of financial objectives, but we're now going to look at delivering social returns while maintaining that objective. So, for example, you might have a financial objective of CPI plus 6%. Your social objective might be poverty alleviation, and you rethink about where you sit on the grant and return continuum in order to maintain that financial objective while maximizing your social objective. And when you do that, opportunities become available. There might be concessionary loans where you're willing to earn a 0% interest rate, and that 0% interest rate is effectively covered out of what was your budget for pure grant-making activities, while your main endowment still supports your 6% plus returns objectives. So you can blend instruments from grant through to clear return objectives that straddle the return continuum, deliver you greater social returns, but leave your aggregate financial return intact. So that does not get affected. So that's the idea. Now, that's a very abstract and very simple way of conveying an idea that I want to get across. There are loads of challenges and complexities around this simple idea that I'll talk a little bit about now. One is the tax treatment. So it's not that clear how foundations that put money into, say, concessionary finance instruments should be treated from a tax perspective. Is it really a non-profit activity when you are earning some kind of return? But tax law and other related regulation is evolving to deal with that. Just something on blended finance. Adam Gray gave a great example on their fund with the First Rand Foundation that has leveraged grants up into a large amount for social impact. And that's a good example of blended finance. So you can see this, what we call a waterfall, where you have donors providing grants at the bottom of the waterfall, where their financial return is minus 100%. You can then have equity investors who take the next level of risk in that they might expect some financial return, positive or negative, depending on the experience and the outcome, but they absorb some of the risk. You have mezzanine funders who are debt providers, but their returns are tied to the actual performance and meeting certain targets. So you could have, for instance, step-up coupons where if a project fails to deliver the social returns, there's an increase in the coupon that has to be paid. And then you can have senior debt funders who are really traditional investors who would choose between, say, a normal government bond, but could alternatively choose debt into this instrument, which is going to have a fixed financial return, but a greater social outcome as well. So this is the idea of leveraging. A donor can put money in at the bottom here and leverage it up into larger amounts. There was the interesting question about whether this might be throwing good money after, or putting in good money that leads to bad, or throwing bad money after good. And the idea that donors are always a first loss investor. I think you can have really bad incentive outcomes when a donor is perceived as basically someone who'll pay the school fees in order to learn what a particular strategy is going to look like. What you need is a blended finance model is a really coherent understanding of what the grant is doing. It can be gap funding, so a project might simply be unviable without some grant element to improve its overall financial return structure. So gap funding is a really important thing that a donor can do to move a project from non-viable to viable. The other important opportunity, which also works better from a regulatory point of view, is instead of blended finance in a single project, you blend projects, each have a different kind of finance. So your donor, for example, might put money into the highest risk end of a united supply chain, for example, in supporting early childhood development, whereas you then have other players who would fund primary schooling, moving through to the job. So you have a supply chain that uses different finance elements in separate legal projects. So you don't have to worry about the complexity around contracting through a blended finance model like this. Just some examples. I think Frank mentioned the Ford Foundation. It's a really, really interesting step the Ford Foundation has done in issuing $1 billion social bond. So what the Ford Foundation has wanted to do, they have a $13 billion endowment, but it is constrained by its investment policy structure to meet certain liquidity requirements. So the foundation doesn't want to take the hit of liquidating a long-term portfolio in order to increase grant making for the current crisis. So what it's done is issued a social bond to raise $1 billion that can support grant making immediately, and then the foundation is going to repay that $1 billion over the next 30 to 50 years through the cash flows from the foundation. So in effect, what it's done is present valued and brought forward future cash flows in order to deal what it sees as a real generational crisis that requires a major step away from business as usual as a foundation. So really interesting financial solution to a cash flow problem for the foundation if it wanted to immediately increase its grant making. So we talked a bit about social impact bonds, and Adam mentioned the bonds for jobs, the ECD bond. Pay for performance bonds like this are interesting, being used around the world. As Adam says, there's been a lot of learning. The South African examples have not been plain sailing. There's a lot of complexity. But the broad structure is right, where you can use these to de-risk a social impact investor who wants social outcome, but only wants to pay for it if those outcomes are actually delivered. And then you have a more traditional financier who will put capital at risk, and they'll lose that capital if the social outcomes are not achieved. But this kind of is meant to motivate the sort of entrepreneurial thinking that a sort of startup mentality will take with financing into a non-profit environment in order to make sure that outcomes are indeed achieved. I think it is working better in theory than in practice so far, but there's a lot of opportunity there. I think other good examples of creative thinking, the JP Morgan Foundation is one we've looked at quite closely, where as a bank foundation, it does things that I think most South African foundations would consider quite uncomfortable, in that it sees its mission as magnifying the social impact of JP Morgan as a group, where it thinks it can use its grant and foundation functions in order to unlock communities in order to access the wider group. And the idea is by doing that, it can maximize social impact. So it can work with communities to be able to access the main products of a JP Morgan by conducting social development. It can be skills development, creating jobs, creating companies and economic activity that then is sustainable because they are then able to access the main businesses' opportunities. So the way forward for foundations, and here is just some practical steps, and we can talk a lot more about this in questions and answers. So feel free to put your questions out there. The first step I would say is get some clarity on core foundation aims. Understand firstly whether your foundation portfolio, what is the relationship in your investment policy statement to those foundations and aims. Are there things you can do from an impact investing standpoint that would align the management of your core portfolio more closely to your social objectives? Then engage with your traditional asset manager and consultants and discuss the investment policy statement and how you can change their activities so that they deliver impact that fits your mandate by using your portfolio. Now, in South Africa, the traditional asset management industry is also learning, is also developing impact insight and understanding. I think there'd be a lot of conversations that would be quite awkward if you go to your asset manager and say you want to start seeing reporting on impact of the foundation and of impact of their investments, and you want to implement certain impact strategies. But it's the kind of conversation that would start pushing things in the right direction. I think next is to look at the existing project portfolio and develop an understanding of whether there are revenues that are implicit in that portfolio, whether there's economic value being created that could be used to support any kind of financial instrument. Now, a financial instrument fundamentally is one that has some form of yield. There are many charitable activities where financial instruments just cannot be used. One is not going to develop financial instruments to support basic healthcare, for example. But in developing jobs, in developing new kinds of business opportunities, and creating economic activity, there are lots of areas where economic value is potentially being created, and that can then be funded in return for a yield that stems from that economic value. And those are the sorts of opportunities to look for in an existing project portfolio. Then the next question is the supply chain around existing projects. So even if one is involved in sort of health outcomes, which on its own can only be supported by grants, it's usually the case that there are businesses in the supply chain around those outcomes. And by intervening in the operations of those businesses, one can lower the costs of them to increase the availability to the grant program itself. So there are opportunities to use impact investing into that supply chain to increase the overall impact of the charitable element of that supply chain. With the big step comes in step 6, where you think about your endowment and assets and whether there are instruments that you can now start to invest in yourself. And I think that's a conversation with an asset manager where we've seen some foundations say, right, I want to take 10% of these assets out of the endowment that you manage and create a new impact fund. And I'm now going to use this impact fund to directly fund opportunities around our grant-making portfolio where there is some yield that's going to support a return on those investments. So some foundations in South Africa and particularly in the rest of the world have done that. That becomes, I think, the Holy Grail. Our view is that this should never be something that's done without broader market support. I think, we spend most of our time dealing with traditional investors, and one gets a very clear view that market mechanisms are critical to maintaining discipline in how financial management happens. So there are all kinds of things that can go wrong when you don't have some form of market discipline over the instruments you're creating and the instruments you're investing in. It needs to be, so creating instruments that only you investing becomes problematic. You want instruments that the rest of the market can invest in which you can invest alongside them as a much healthier form of practice. So I think I'll leave it there. I'm very happy to discuss more in questions and answers.
Yeah, no, I was just going to help you a bit and read them out because sometimes it's difficult to navigate a little bit.
I found them
There's
now.
actually interesting question around Peter, who says, last year he was speaking at the Social Enterprise Forum for Africa in Durban and met great social entrepreneurs there, but the representation of impact investors was almost zero. Is that also your sense, and what's the awareness level in South Africa in general?
So it's a good question. Look, there are lots of fund managers out there who believe that they are doing some form of impact investing, where really what they're doing is a bit of portfolio tilting towards ESG. They're not rolling up their sleeves with trying to find social entrepreneurs to fund and so on. Our focus is on those traditional managers who are doing that. And I think there are very few funds who are active impact investors at the social entrepreneur end of the scale. And there are some. There are some in South Africa, but there are very few. I think the work that needs to be done, and it needs to be really driven by the non-profit sector rather than expecting the traditional fund management industry to do it themselves, is to figure out how one creates finance structures that you then can go and sell to the asset management industry rather than expecting the asset management industry to come to you. Because it just doesn't work that way. The asset management industry is fundamentally one where those seeking finance go and approach and pitch opportunities to them and raise funding that way. But one has to get it right in creating the right institutional framework and infrastructure to take opportunities to them.
No, and I think that's a really good question, right? And it also speaks to the question I was asked to both Frank and to Adam before, where should some of the innovation happen? And what you're saying is it should really happen in the products that's also taken to asset managers. And I'm guessing also to some extent what we've heard before, make it walk a bit like a duck, hey?
Exactly.
And make it look like what asset managers are used to and maybe hold back on the innovation to some extent. Would you agree with that?
Yeah, exactly. So we did work on a social bond for the South African government to issue. And it was really interesting engaging in market sounding with asset managers on that. So we went to some of the biggest asset managers in the world, and there was very warm feedback. So there really is an understanding in the asset management community that it's important to have social impact. But you get a kind of mix of views. You get one that says, I have a mandate from my pension fund clients to maximize their returns. And you're now asking me to effectively sacrifice some elements of their future well-being for you to issue a social bond. And I think to Adam's point earlier about not sacrificing government returns, I think when it comes to traditional debt instruments, particularly bonds that a government issues, the social bond should be at a lower yield than a normal bond, right? You as an investor are buying social impact, and that comes to you at a cost. And the investors we engage with understand that, they recognize that, but it has to be a very well motivated decision for them to make. So you've got to understand what their mandate says, what it says about ESG, what it says about their reporting obligations to their end clients, and say to them, by doing this, we're going to make your reporting obligations much better. We're going to enable you to fulfill your mandate to your end clients, and it's therefore worth you giving up some yield in order to invest in this instrument. And you've got to have those bases covered.
Great. Thank you. Let's actually take one more question, then let's start wrapping up, because I appreciate it's been a long afternoon with also lots of information. Question 1, is impact financing doable in municipalities or local authorities projects? And if so, is government guarantee required?
So it depends exactly what you mean by impact financing. It's certainly doable in municipalities and local authorities. And in some ways, the ECD social impact bond is an example of what local government can do to Western Cape. But if you consider impact investing to include things like social infrastructure, which can be energy, water, sanitation projects, those are all municipal competencies, and they absolutely can be done through some kind of impact investing framework. And there you would have a PPP where private investors are involved in backing the project, and those instruments that they're using can be designed as ESG instruments. You might need a government guarantee simply because the balance sheet of the municipality isn't strong enough to handle the financial risk. And investors might say, we're not willing to take the financial risk of this municipality, so we need the government to guarantee it. Yeah, that can happen. Your question on minimum loan term as well, I see, in the IPP program in South Africa, those were 20-year projects. The longer your term, generally the lower your yield, although that really depends on the yield curve to some extent. But in less creditworthy situations, particularly smaller municipalities, it's going to be short term. You're going to have 3 to 5 year kind of yield. The government itself can issue 30-year bonds, although I'm not sure it can anymore. 2 years ago, it could issue 30-year bonds. Are there thresholds in terms of the loan amounts? I think it really depends on the project, right? In order to get some economy of scales, things do need to be big enough to justify the setup and all of the contracting and so on. But you can do mega projects, and you can do reasonably small projects as well, of a few million rand up to billions.
Thank you, Stuart. Let's perhaps pause there and say thank you to all of the speakers. Really, really appreciate it. And thank you to everybody who stayed with us. I think I just talked to my colleague, and I think 2 hours for a webinar is probably our record long webinar. So thank you all for your patience and also for the conversations. Really appreciate it. If you would like to engage with us further, then please don't hesitate to just drop an email on berthacenter@gsb.uct.ac. I am frantically trying to find, as you can see, also just a link to sign up to our newsletter, which also contains information on all these webinars and everything related to the National Task Force for Impact Investing, including the Foundation Working Group. So it really is one of the best ways to just stay updated on all of the market building work that's happening in impact investing. So thank you everybody for joining us, and we will see you out there soon.
Thanks everyone.
Thanks everyone.
Thank you.